This is another video about Roth conversions, but I'm going to take a little bit different of an approach in this one. Typically, when you see videos on Roth conversions, you're going to see software modeling, and that software modeling is going to assume a certain earnings rate for the accounts that are being converted or the converted accounts, meaning the tax deferred money converted to a Roth account, and they're going to run a projection of those earnings over time. Now, here's the problem with that. You really need to go one step further, and here's why. We all know if we've invested for a certain number of years, your account does not just go up a certain percentage every year. That's not how markets work. So it's actually better to compare tax savings between a Roth conversion strategy and doing nothing using a realistic sequence of returns. Now, if you're watching this, you're probably familiar with Monte Carlo analysis, where you're going to take a certain income and you're going to take a certain retirement period, and you're going to take a mix of assets, and you're going to run 1,000, maybe 10,000 trials and figure out what is the probability that, given the sequences that could occur, would you run out of money. Now, that's great, but in reality, when you're looking at Roth conversion versus not converting, it's not going to materially change that probability of success. What it is going to change is your probability of flexibility. So I want to show you that in this video. I'm going to go one step further. So if you're looking at Roth conversions and you've just looked at a sequence of earnings into the future and you've run it in a linear basis, I want to show you why that can give you a wrong sense of how you should be thinking about what you're paying now versus what you pay over time. I'm Forrest Dutton. I'm the owner of Brightworks Financial Planning. I'm a certified financial planner, and my goal with these videos is to help you retire with confidence. Now, without further ado, on to the rest. Okay, so on the screen here, we have our client, Bill. We're going to do a scenario today and talk through this concept of how do we think about Roth conversion taxes over your lifetime, and how does it interact with the potential returns that you might make in your portfolio, both on the converting side and the converted side. So what we have here is Bill has a net worth of exactly $5 million. He's 50 years old. He wants to retire at 55. So I'm showing you a snapshot of where he is now. He has $4 million that's in a tax deferred account. In this case, it's going to be a traditional IRA. And he also has $500,000 in a taxable brokerage account. Now, we have a property here as well, but I want to focus more on these assets that are going to be utilized in retirement, which is the $4.5 million. Now, what are his goals? He wants to live on approximately $10,000 a month. He's going to have travel budget of $5,000 a year. He just wants to go on one trip per year. He has a $3,000 out-of-pocket medical expense to go on top of $1,000 a month for his medical premium expenses prior to Medicare. So that gives you a snapshot of where he is. Now, in terms of retirement, you could probably look at the math there and notice he's going to be in pretty good shape if that's all he needs to spend, assuming we go forward on an inflation-adjusted basis. Now, here's where it gets interesting. I'm going to take you into the details of this plan. Now, what I want you to see here is, first, what we're going to show you is, I'm going to show you age 55. So you're seeing this is year 2031. So we're going to spend, and I'm going to move, before we talk about conversions, I'm just going to talk about the expense piece. So again, we're looking at our all-in expenses, $153,000. We have a goal of $5,000. That's going to inflate, and he's only going to really do that. He wants to see the world. He wants to travel between 55 and 65. So that goal is going to inflate for 10 years. You see that. We've got tax payments, but they're really not bad because we're utilizing our brokerage account for the first 5 or 6 years. And so this is our total outflow. Now, what is happening in terms of the returns on that $4.5 million during that period of 55 to 60? This is the interesting part. Now, most softwares are going to do this. They're going to take age 50 and they're just going to continue to inflate. So basically, by the time Bill retires, he has $6.4 million. But in reality, we don't know what can happen. So what I'm going to do is model some down years and also a more reasonable sequence, which would be 3 negative years out of every 10 years. We know the stock market is most often positive, but there's 2 or 3 years they're going to be negative. So in this case, notice the big difference there. That means when he gets to retirement, he is at $5.3 million roughly, right, in his portfolio. So that's a little bit more realistic. Now, why is that important? Here's why it's important. Because I'm going to show you what this plan looks like if we do Roth conversions between age 55 all the way to age 70 when he takes Social Security all the way through to 32% bracket. Now, just to suspend judgment for this video alone, this is not for me to explain to you how I came to that conclusion, but I want to show you how you might want to compare this if you've already decided, okay, I want to do conversions to the 32% bracket, utilizing two different scenarios. So let's go back to a baseline assumption. And what I'm going to show you here, we're going to go back to this summary. And what this is going to show you is, notice you're going to see the big difference. All of a sudden, this tax column is going to jump up. Okay, so what you just saw was 2031. It went from $16,000 to $129,000. That's because we're doing large conversions for many, many years. You can see that going. We have six-figure tax bills all the way to age 70. Then after that, in this case, because this baseline scenario, remember, what's happening to the portfolio during these conversions? This is what I want to show you, and this is what's often missed. So in the background, notice age 55, 2031, all the way to 2046. Despite the fact that we're doing these large conversions, what's happening to the accounts? Okay, the answer is they just continue to compound. So we're going higher and higher and higher, right? We started at 6.3, so just to put your cursor on that, then we go all the way to 2046, and we're all the way to 8.9. Now in reality, that just assumes, according to how I've allocated these assets in this program, that it's going to run at a rate of 6%, 7%, however aggressive I want those accounts to be. In reality, we know the market doesn't work that way. So what might be a more realistic way to view this? Now here's why it matters. Required minimum distribution payments, when you get to the age that you have to do that, so if you're born in 60 or later, that's going to be age 75, 60 or before, that's going to be age 73. Those payments are based on the year-end value of the traditional IRA the year before. So if you look at this, notice we're continuing to take the traditional IRA lower, but what can happen here is, because it continued to grow on top of the conversions that we had, we still have it in this plan at age 75, we still have money that is going to cause some tax throughout the rest of our life, right? So that's the baseline plan. We're not actually doing conversions, meaning notice it continues to grow. And in this case, what I want you to see is what happens if that sequence changes. So just to be clear here, what's happening in the background is we're running at a linear rate of return. Could be 5%, 6%. But in reality, that required minimum distribution is going to be predicated upon the changes that happen in the account the year before, which in some cases could be negative. And I would argue at least two out of every 10 years is going to be negative, most likely. So in this case, what's happening here is this baseline case, we have such strong growth happening in the background that we still have required minimum distributions in this plan. Now, what I want to show you here is what happens if we change the assumptions. So instead of continuing to grow, notice our traditional IRA draws down. The reason being, not only are we converting from it, but there are a sequence of returns that are happening such that the growth is more realistic. So in this case, this person gets to 92 and they had a great life. They converted over $3 million of tax-free money by age 76, and in that case they lived off it to the rest of their life and they had a great plan. Now for some of you, you may say, well, I don't like that. My goal is to have $5-10 million in Roth. You might, but my point is saying you need to model the tax based off the different scenarios that could occur. So let me go back to this, and I'm going to go one level out so you'll clearly understand what I'm doing. So notice age 55, that's when we're going to start doing these conversions. Now if I go to summary here, what this is going to show us is our tax payments are here, and they're large for the first decade and a half, 15 years, and then they level off 50,000, 60,000, and they continue to grow for the rest of the life. Now in this case, That's what we would call conversion scenario 1 baseline return, meaning it's just a flat linear return. So these taxes are going to continue for your whole life. Now, what would be conversion scenario 2, where we have a sequence of returns? That would be this. And in that case, the payments end up being lower because markets were such that you were able to actually convert all that money before you got to the point where you had to do required minimum distributions. Now, why is this important? And this is where I'm going to show you the Excel. So what I did was I just literally took those tax numbers, stacked them up from age 55 to 92. So I just went over with you what is conversion scenario 1 baseline, meaning we're going to do 32% tax bracket Roth conversions from 55 to 70, and notice we have our large tax bills for doing that. When we get to 70, then we continue to have taxes because there was strong growth happening in the background, so we weren't able to get rid of all of that pre-tax money. So therefore, your taxes are going to start over at 71 and then just build back up. They're not near what they could have been, but they're still high. So the total tax in that case would be $3,447,000. Now, what would be the difference there in realistic return sequences? Well, the difference being you converted all the money. So you were able to pay those taxes up front because the balance went down. Now, to be fair, your portfolio did draw down as well. But I would argue that is a more realistic scenario 2 model, which again is a big difference. That's a difference in $1.4 million. So if you're looking at what is my lifetime tax, I would argue that conversion scenario 2 is more appropriate than conversion scenario 1. Now, what would be the difference there if we do nothing, right? So I'm calling this baseline. So meaning instead of a realistic return scenario, it's just we do no conversions and the account continues to accrue at 6%, 7%, whatever it is. Because even our real rate return is still growing. So what happens here is taxes just grow linearly, and this is what you often see in these scenarios in software. So again, notice that's a big difference between even the first scenario is 5.8 million. Now I would argue, what is the actual no conversion scenario? Meaning we use the same realistic return sequence, but we don't do Roth conversions. So in reality, do we have taxes through the rest of our life? Yes, but do they even hit 6 figures? In this case, the answer is no. So I would argue the best 2 things for you to be looking through is what is scenario 2 versus scenario 4. And as you can see, the only difference here is we did Roth conversions in scenario 2, which is roughly just a hair over $2 million of lifetime tax. And in scenario 4, we did nothing, but we also modeled the same sequence and the same income that we had as part of our goal. So what I'm trying to point out here is that you need to do Roth conversions in some cases, not just because of the total tax paid. But notice in scenario 4, starting at age 75, this person has flexibility. So these numbers they want to pay, they have no choice, right? These are forced payments. This person has flexibility. If they don't want to spend as much, if they want to give and they want to change their lifestyle so that others can be enriched while they're living, that Roth conversion plan has room for that. This one does not. So this is my simple point of the video is when you look at these scenarios and you just see these RMDs increasing every year to a drastic amount, I personally do not think that's realistic. Markets don't work that way. Life doesn't work that way. So when we're looking at Roth conversions, make sure that we're modeling something that is realistic. So that being said, I want to now say, what do you think? Is this realistic in your mind? Is this something that you think makes sense? Love to hear your comments. Have you looked at it this way, or have you only seen it run the way that I described before? Because the results can be very different. So as always in this video, this could be right for you, but it's not meant to be personal advice. So it's meant to be educational. Everybody's situation is different. I hope it is helpful though to give you another lens, and honestly it's one I don't see as often out in videos, especially amongst social media. So please comment, subscribe. I would love to reach more people with this channel. I'm going to continue to do content, but I want to know what you want to see. I want to know what you want to see modeled. So hope you enjoyed the video, and I will see you on the next one.